Overdrafts are great. They're flexible. You can dip in, dip out. There's things like Invoice Factoring, which over the years has got a bit of a bad name. And essentially what that means is that you are selling your invoices before they're paid. So your debtor's ledger is really the biggest asset in most companies. So it's sat there and we're waiting 30 days for someone to pay you. But what an invoice factoring company does is they effectively buy the invoices from you, and they will raise a vast majority of that cash up front, so it releases that cash flow. You'll pay a price, but having money today as opposed to having it in 30, 60 days time is of huge benefit. The problem with something like that, and sometimes with overdrafts, you've got to remember though, is that they will require some form of security. So when you're trying to free up cash flow, you're sometimes trading that off against the director having to put security up by way of personal guarantee, maybe even charges on certain assets, personal assets. Bridging loans, they tend to be around sort of property companies. They can be quite dangerous because if you miss deadlines or projects don't quite go to plan, then the fees and the charges that can be put on them are huge. So if you are using facilities like that, one of the most important things is, perversely, you've got to remember to borrow probably a little bit more than you thought. Because if we remember, if you need £1 million and you go and borrow £1 million, actually there was a bit of a time lag in there. We need a little bit more. It's going to take 6 months for that cash conversion cycle to kick back through. Actually, we need 1.3. So yes, bridging loans can be a useful thing, but they can be very expensive. But things like invoice factoring, they've really changed the sort of way a lot of companies operate, and they're absolutely crucial for freeing up their cash and allowing them to trade and allowing them to grow.